Hello everyone, welcome to Tesla Daily News. Today is June 25th, Wednesday, and the following is the latest Tesla news. According to market data, Tesla shares finished the latest trading session at $375.53, down from the previous close of $381.61. The stock opened at $380.08, traded between an intraday high of $384.58 and a low of $373.05, on volume of about 36.9 million shares. Technically speaking, Tesla closed in the lower half of its daily range, suggesting short-term selling pressure after failing to hold above the prior close. Short-term traders will be watching whether the 373 area holds as near-term support and whether bulls can reclaim the 380 to 385 zone, which acted as intraday resistance. 10-word technical view, failed to hold gains, watching support near recent intraday lows. According to NHTSA, Europe has reached a historic turning point in vehicle sales, and Tesla is one of the largest beneficiaries. For the first time, across the combined markets of the European Union, the United Kingdom and the EFTA countries, fully electric vehicles have outsold gasoline-powered cars in the month of May. Electric vehicles reached a market share of about 23.3%, while gasoline models slipped to roughly 21.7%. From an investor's perspective, this confirms that battery electric vehicles have moved decisively from niche to mainstream in Europe, which is one of Tesla's most important markets outside North America. NHTSA mentions that in the year-to-date through the end of May, within the European Union alone, fully electric vehicles reached a market share of 20%. They still trail gasoline cars at about 22.4% and hybrids at roughly 37.8%, but the trajectory clearly favors electric models. Plug-in hybrids also gained share to just under 10%. At the same time, gasoline car registrations dropped by more than 18%, and diesel registrations fell by roughly 16.5%. Diesel models now account for only about 7.6% of new registrations in the European Union. According to NHTSA News, Tesla has been one of the standout winners in this European transition. The article notes that Tesla's overall European sales in May nearly doubled compared with a year earlier. The Tesla Model Y remained the best-selling electric vehicle in Europe, with over 17,000 units sold in May, representing a gain of roughly 68%. It was not only the top electric model but also the third best-selling vehicle of any powertrain on the European market. The Model 3 delivered an even more impressive percentage increase. Sales surged about 198% to more than 9,500 units, making it the second best-selling electric model. For Tesla investors, these figures are critical. They indicate that Tesla continues to defend and expand its leadership in the European battery electric segment even as competition intensifies. Strong volume growth in Europe can help offset pricing pressure and margin compression. The Model Y's position as a top seller across the entire market, not just among electric cars, also reinforces Tesla's brand strength and scale advantages in manufacturing and software. If these trends persist, Europe could remain a powerful volume and revenue driver for Tesla over the coming quarters. According to HVG in Hungary, data from the European Automobile Manufacturers Association, ACEA, confirmed the broader transition that underpins Tesla's European performance. In the first 5 months of this year, more than 950,000 battery electric vehicles were registered in the European Union, giving pure EVs a market share of about 20%, up sharply from 15.3% a year earlier. Meanwhile, gasoline's share declined from 28.5% to 22.4%, and diesel slid from 9.5% to 7.6%, while hybrids climbed to nearly 38% of the market. HVG mentions that Tesla's own sales in the European Union climbed by about 77.3% in the first 5 months of the year, reaching nearly 90,000 vehicles. This sustained growth, across several months rather than a single strong delivery month, suggests that Tesla has been able to maintain solid order flow and production allocation into Europe. It also indicates that the company's ongoing software updates, supercharger network, and brand recognition remain powerful differentiators for European consumers. At the same time, according to both HVG and NHTSA, Chinese electric vehicle manufacturers are expanding aggressively in Europe, creating a three-pole market structure that investors should watch closely. HVG reports that BYD's sales in the European Union rose by about 158.9% in the first 5 months, to nearly 100,000 vehicles, meaning BYD actually sold more vehicles than Tesla in the EU over that period. NHTSA further notes that across Europe, including the United Kingdom and EFTA, Chinese brands as a group reached a market share above 10% in May, roughly doubling their sales year over year. Index HR explains that BYD's sales in Europe grew about 145% to more than 135,000 vehicles, allowing BYD to surpass SAIC and become the best-selling Chinese carmaker in Europe in May. Other Chinese groups such as Geely, SAIC, and Chery are also expanding, with some sub-brands like Li Motor and Xiaopeng posting extremely high percentage growth from a smaller base. For Tesla enthusiasts, this underscores the increasingly competitive environment, particularly in the lower and mid-priced EV segments where Chinese manufacturers often leverage battery cost advantages and integrated supply chains. From a strategic standpoint, Tesla's strong growth in Europe is occurring even as these Chinese players ramp up, which is encouraging for Tesla's positioning. However, investors should recognize that sustained price competition, potential tariffs, and localized production strategies will all shape Tesla's margins and market share in the region over the next few years. Regulatory developments regarding tariffs on Chinese EVs and components could also indirectly impact Tesla's cost structure and competitive landscape. According to HEG's coverage, the European market is increasingly described as three-polar: traditional European automakers, Tesla, and the fast-rising Chinese brands. Volkswagen Group still leads the overall European market with more than 1.26 million vehicles sold in the first 5 months, but in the pure electric space, Tesla and Chinese manufacturers are putting serious pressure on legacy incumbents. For Tesla fans, this is both an opportunity and a challenge. If Tesla can continue to innovate in software, battery technology, and manufacturing efficiency, it can maintain a leadership position even as others catch up on electric powertrains. Shifting from growth to controversy, according to HEG in another report from Houston, Texas, Tesla now faces fresh legal and regulatory scrutiny related to its driver assistance systems. The family of a 76-year-old woman named Martha Avila has filed a wrongful death lawsuit seeking $1 million in damages after she was killed when a Tesla vehicle crashed into her home in a Houston suburb earlier this month. The driver allegedly told police that the car had been placed into autopilot mode before the collision. HVG reports that the family's legal team argues Tesla should be held responsible because, in their view, the company failed to adequately disclose the imperfections and risks associated with using autopilot. They claim that the way Tesla presents and markets its driver assistance systems may lead some drivers to overestimate the capability of the technology, potentially contributing to misuse, complacency, or failure to supervise the system properly. In response, Tesla executives have publicly pushed back on social media. HVG mentions that Tesla's vice president responsible for artificial intelligence software wrote on X that the driver manually overrode the autonomous system by pressing the accelerator to 100% in a residential area. Elon Musk also posted that the crash occurred at high speed, while the company's so-called full self-driving system, or FSD, is designed to navigate at lower speeds in residential zones. Both statements suggest Tesla will argue that the human driver, not the system, bears primary responsibility. According to HEG News, Tesla officially states that autopilot allows vehicles to steer, accelerate and brake within a lane, and that FSD extends these functions to include lane changes and responses to traffic signals. However, the company also repeatedly says both systems must be used only with a fully attentive driver ready to take over at any moment. This legal case will likely focus on whether that message is clear, consistent and sufficient, and whether in-car prompts and safeguards adequately prevent misuse. HEG notes that the U.S. National Highway Traffic Safety Administration, NHTSA, is already investigating the Houston crash. Since 2016, NHTSA has opened nearly 50 special crash investigations involving Tesla vehicles where advanced driver assistance was suspected of playing a role. Those incidents collectively involve about 24 fatalities. Earlier this year, NHTSA expanded its probe to cover approximately 3.2 million Teslas equipped with FSD, citing concerns that the system may not function reliably in poor visibility and might fail to provide adequate driver alerts. For investors, this is an important risk factor. On the one hand, Tesla's leadership in driver assistance and autonomy is a major part of the long-term valuation story, especially around potential software revenue and robotaxi ambitions. On the other hand, ongoing investigations, recalls and lawsuits can lead to regulatory restrictions, mandated software changes, reputational damage, and legal expenses. HVG reminds readers that Tesla recalled about 2 million vehicles in 2023 for autopilot-related updates. Each new high-profile crash or lawsuit keeps the spotlight on whether Tesla's systems and messaging are sufficiently safe and conservative. From a product development perspective, cases like the Houston crash highlight the importance of robust human-machine interaction design. Tesla will need to continue improving driver monitoring systems, user interface prompts, and behavior at the limits of the system to convince regulators and the public that its approach to supervised autonomy is safe. Any delays or restrictions on wider deployment of FSD features in markets like the United States or Europe could affect Tesla's ability to earn high-margin software revenue in the coming years. According to Southwest24, Tesla's driver assistance systems have also become the subject of public skepticism and even satire in China, one of Tesla's other key markets. The outlet describes a curious trend where Chinese Tesla owners have begun attaching small plastic heads of celebrities or cartoon characters to their dashboards and cockpits. These little figurines, often stuck or hanging in front of in-car cameras or sensors, have gone viral on social media as a way to poke fun at autonomous and semi-autonomous driving technologies. Southwest24 mentions that behind the humor lies a serious undercurrent of distrust in partially autonomous systems. For some owners, these plastic heads symbolize their unease about how much control the car's software should have and how accurately it can perceive the environment and the driver's attention. The article notes that some of these tricks are technically questionable and may interfere with sensors or cameras, potentially making the systems less effective. Nonetheless, the trend has become a kind of cultural commentary on the rapid rollout of advanced driver assistance features. For Tesla enthusiasts and investors, this Chinese trend is a reminder that public perception of autonomy varies significantly across markets. Even in countries that are embracing electric vehicles quickly, there can be cultural and regulatory resistance to higher levels of automated driving. If Tesla wants to maintain its brand strength in China, it will need to carefully manage both safety performance and user experience, and respond to social media-driven narratives around its Autopilot and FSD features. Finally, according to RTCG in Montenegro, there has been speculative reporting about Elon Musk's personal net worth in connection with SpaceX and Tesla stock valuations. The article claims that Musk's wealth, which it says once exceeded $1 trillion due to the peak valuation of SpaceX shares, has now fallen below that symbolic level after a roughly 31% decline in SpaceX's share price and certain restrictions on his Tesla holdings. Even though the specific figures and the use of the word trillion in this report appear exaggerated and inconsistent with most mainstream financial estimates, the broader point for Tesla investors is clear. Musk's personal wealth is highly leveraged to the valuations of both Tesla and SpaceX. RTCG mentions that Musk's Tesla stake, valued at around $116 billion in this report, is partially constrained by prior agreements with Tesla's board and governance structures. For investors, changes in Musk's financial flexibility or his incentives tied to equity compensation packages could affect his decisions about Tesla's capital allocation, share buybacks, or new ventures. While Musk reportedly remains the world's richest individual even after the decline described by RTCG, volatility in his net worth underscores how sensitive Tesla's valuation can be to shifts in market perception, execution risk, and macro conditions facing high-growth technology companies. In conclusion, today's Tesla news paints a complex picture. On the positive side, Tesla is capitalizing on Europe's rapid shift toward electric vehicles, with Model Y and Model 3 showing exceptional growth and helping to push EVs into the mainstream. On the challenging side, Tesla faces intensifying competition from Chinese manufacturers in Europe, ongoing legal and regulatory scrutiny over Autopilot and FSD, cultural skepticism about autonomy in key markets like China, and continuing volatility around Elon Musk's personal stake and influence. For long-term investors and fans alike, the coming months will be crucial to watch. Whether Tesla can sustain volume growth while stabilizing margins, navigate safety and regulatory concerns, and continue innovating in software and manufacturing will likely determine how the stock trades from here. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for our next update.